Iran war and your retirement. What you need to know: the recent escalation of tensions between America, Israel, and Iran, beginning with airstrikes on February 28, has sparked significant uncertainty. Many Americans are understandably concerned about how this geopolitical conflict will affect their financial futures, particularly their retirement savings. Here's a breakdown of the potential short and long-term impacts, based on market analysis and expert projections. Short-term market volatility, weeks to months. The immediate effect of the conflict will likely be increased market volatility. Investors tend to react to geopolitical instability by selling off riskier assets, potentially causing a sharp, albeit temporary, decline in stock values. The S&P 500 could fall by 10% or more if the situation escalates. For retirement savers, this translates to potential short-term losses in portfolio balances. However, these drops are usually followed by recovery as tensions ease. Beyond equity drops, the war will likely drive up oil prices, adding approximately 0.7 percentage points to global inflation. This means higher energy costs, which erode the purchasing power of retirement savings and depress bond yields. Investors typically seek safe haven assets, such as U.S. Treasuries, gold, and the U.S. dollar during times of crisis. This shift in funds can further depress the value of growth stocks and emerging market investments, while boosting bond performance. Long-term economic outlook, years and beyond. Historically, financial markets have shown resilience in the face of geopolitical conflicts. The initial shock is often absorbed over time, with minimal long-term impact on retirement investors. However, a prolonged war lasting years could lead to sustained higher interest rates and inflation. Increased defense spending and government deficits contribute to these pressures, diminishing the value of retirement bonds and overall savings. The key takeaway is that long-term market recovery is probable, but the duration of the conflict remains the critical factor. The longer the war lasts, the greater the risk of inflationary pressures and long-term economic disruption. Bottom line, the most immediate threat to retirement savings is short-term market volatility and rising inflation. While a full-scale global conflict remains unlikely, continued escalation will drive down equity values and decrease the purchasing power of savings. Unless the war expands into a broader, unpredictable crisis, markets will adapt over time. The Iran war's impact on retirement accounts is largely dependent on its duration. Short-term swings are inevitable, but long-term recovery is expected, assuming the conflict remains contained.